Sahil Goel, who's Managing Director and Chief Executive Officer at the newly listed Shiprocket. And then there's Tanmay Kumar. He is CFO at Shiprocket joining us. Welcome, gentlemen, and congratulations on what's been quite a bumper listing. I'm sure that shareholders are happy. But let me first start off with the larger picture, right? Sahil, let me start with you. How does Shiprocket look now that the fundraise is behind you, and what's the sense like maybe in the next year or two? How should things evolve? Just give us a sense. FY28, FY29.
No, thanks. It's a fair question, I guess. So I think, look, the fundraising and the IPO is. We were doing a town hall a few days ago, and we called it a mere checkpoint in the journey because so nothing has changed at Shiprocket in terms of how we build, in terms of the problems we solve, in terms of the aggression with which we want to go after our merchants. All of that continues, right? And it's a great validation, right? Where from a few hundred shareholders to getting a few 100,000 shareholders to believe in the mission is a great validation for us and our entire team. I think just from an outlook perspective, we have two parts of the business, core and emerging. The core business is where we help our merchants with shipping, right? Post-order experience and so on. Pre-order plus omnichannel plus cross-border makes up the new emerging business for us, including advertising, right? So that business is growing much faster than the core business. It's the same customer and the same transactions that are being kind of monetized multiple times and solving multiple problems for our merchants along the way. So that strategy will continue to kind of continuously invest behind the emerging business to continue driving growth. And that's sort of the way we intend on continuously driving and solving problems for merchants. And it's a very, very large market, right? There's over 6 crore MSMEs in India. Shiprocket powered 200,000 of them, north of that last year.
Okay, Sahil, Tanmay, hi, morning. And either of you can step in for this question. Before we try and dissect your financials and get into numbers, just want a sense of how the logistics sector is shaping up on the ground, given that cross-border shipment is such a big opportunity for you, and you've spoken about that during the listing. How are you looking at costs right now, given everything that's happening in West Asia? Has anything materially changed for you in terms of timelines and costs?
See, I think there are two parts to that problem, right? With the fuel costs and so on. Let me talk about the domestic part first. I think from a domestic perspective, because India is going through multiple kind of transformations at the same time, you've got cost of logistics dropping because of rising volumes, better transportation, like physical road transportation vehicles, as well as physical infrastructure. All of that is happening together and growing consumption, right? So I think it's like from our platform's perspective, we haven't seen any major change yet. There has been some cost increase and so on. And given Shiprocket will kind of reflect what the market does or what the market is, it will reflect the same thing, right? As the macro. And at the moment, we don't see a huge change or disruption in the overall, being pushed down to the consumer at least. From the cross-border perspective, obviously, it's been we've built a network where we've gone and connected freight forwarder with India and using our domestic network and foreign last mile to bring it all together to, be able to get a small exporter sitting in a tier 2, 3 city access to, US audiences or European audiences or UK or Canada and so on by listing their products across different marketplaces, right? So that's the unique thing we're trying to get to Indian merchants. And there's obviously express parcel use cases, and there's also going to be marine and bulk use cases over time. So we're digitizing that, right? And it's a great opportunity. It continues to be one for the long term. I think the current macro and sort of geopolitical situation obviously makes the export piece difficult, with merchants themselves losing confidence sometimes. There's too much volatility in terms of rules and regulations, even at the foreign ports, right? And it was followed by tariffs, if you remember, right? There's a bunch of tariffs that were getting applied. So I think it's an interesting time for a platform like us to solve compliance, to solve whatever we can, and try to stay on the edge of this to help our merchants, not have to go through these complications. I think that's what we're focused on now.
Tanmay, typically immediately after listing, what tends to be the investor's mindset or mentality is to try and understand how quickly you can get profitable, right? Essentially. You're currently, the growth clip is extremely strong. So last 5 years, you've done 3x in terms of your top line. Firstly, can top line continue to grow at that clip on the base that you are at now? And at what point do you get EBITDA breakeven, PAT breakeven?
Sure. So let me answer this in two ways. Number one, as you know, that the core business generated 187 crores in adjusted EBITDA last year. The profitability for core business has been growing year by year. And not only the profitability, in fact, there are multiple levers inside the core business itself. So for example, every additional value added service in core itself comes with almost negligible acquisition cost, which means that the core margins have strengthened, and overall there has been significant operating leverage there. The emerging business has grown at 65% plus, and you could see the trajectory from a minus 80% to close to minus 30% adjusted EBITDA. That's been the trajectory there. So therefore, if all the transactions that we're doing are incremental to bottom line, because we have a very strong 21% contribution margin for the core business, and overall also it's almost 18% plus. So every incremental transaction in our business adds to the bottom line, and we are consciously therefore only investing in certain fixed costs in terms of payroll and so on. Now, looking at the trajectory itself, it's fairly, directionally, it could come out that the margin improvement becomes very, very significant from a EBITDA margin perspective, quarter by quarter, and that's been the trajectory for the last 3 years. So I would essentially say that the margin expansion and the company becoming profitable here is a function of how's the adoption depth and it's not a function of raising prices. It's essentially just the growth and the adoption depth. And if that continues the way it's been continuing, I would see our shareholders always being happy.
Point taken. So I want to quickly split this up, right? 70% of your top line is core, 30% is emerging. How do you see these evolve versus overall top line growth in the next 2 years? First, give us a sense of that. Let me try and break this up.
Yeah, sure. So, I get this question often. Let me give you a few lead indicators which will actually help this conversation. So the emerging products are being sold to the same set of merchants who are using core. So this means that it's all happening at a much lower CAC, and essentially what we are driving is two things. We are driving a product adoption per merchant, and we are driving revenue per merchant, right? If those two levers are directly moving up every time, right, the mix is going to be a derivative of that, right? Now, good news is that for last 3 years, right, our average revenue per merchant has been growing, and the adoption has been very, very strong. We have close to 86% overall consumer repeat as another number, which means merchants are coming to us over and over again, and therefore the trajectory to me is going to get derived from these two numbers. Clearly, emerging will become stronger, but bear in mind that it's a function of core growth as well, and we are equally driving core growth.
For this, you very clearly highlighted how emerging has improved in terms of margins, Tanmay. Adjusted EBITDA going from -70 to -30. Could you give us a sense on how quickly it reaches maybe -20, if you can give us that perspective, just in terms of timelines as to how the journey goes?
If you look at overall P&L and emerging P&L, let me just break this for you, right? Overall margins in an emerging business are fairly healthy. They are actually stronger, right, than the core, because there are multiple elements to this, like the MarTech business, which has a very, very strong margins, and that's growing very, very significantly. Below this are costs in product tech that we've been investing in, to drive and build more and more over a period of time. The investments are some bit made and will not increase at a much higher rate than the rate of growth of the business. You've seen the movement from -80 to -30, which is like a 50 percentage points growth in just 2 years, right? Now, Therefore, to me, it's just now, I would point to the direction for you to quickly infer where it can land. We are very, very positive that this should drive more value as we go forward.
Okay, and Sahil, just want to understand the pivot to quick commerce. You're trying to build a presence over there as well. Just trying to understand what the model over there is going to be. Are you going to continue to be asset light, or are you looking at owning some part of the fulfillment layer?
No, I think it's not a pivot to quick commerce for us. I think we've been doing omnichannel commerce since 2022, 2023. What started with 2-day delivery from our partners of fulfillment centers, right, has now become our dark store delivery network for 2-hour delivery, as well as our retail store delivery network using hyperlocal. So essentially, it's the same playbook what we did with express courier shipping, where we are bringing this service to smaller businesses, direct brands, D2C brands, and anybody who wants to give, the spectrum of quick deliveries from, half an hour to 2 days. And that's what the omnichannel commerce business enables. It also is enabling us to allow merchants to do better on the quick commerce marketplaces. So we've got integrations with platforms like Blinkit, where the brands, when they get a PO, we are able to kind of aggregate that information, plan a route better, again, using all third-party transport, right, using our technology, and then have it reach there in time to be able to meet that appointment, for example, right? So that allows the brands to have lower stockouts, higher conversion rates because of the orchestration that we're able to power. So I think, it's a great time to be building a Shiprocket-like platform where the underlying actual physical infrastructure is being made by sort of our very, very strong delivery partners on the network. And obviously the merchant use cases and consumer use cases continue to evolve in terms of experience and digitization. And that's where we step in.
Understood. Sahil, Tanmay, thank you so much for your time. Good to be speaking with you. Once again, congratulations on the listing, and we're going to be keeping a very close eye on that EBITDA break-even. Hope to interact with you on that more next time. Thanks so much.
Sure. Thank you.
Thank you so much.